You can do everything right in retirement and still get hit with what feels like a stealth raise. It's called IRMAA. 2 years after a big stock sale or a Roth conversion, Medicare tells you your premiums are going up. This delay is why it feels so unexpected. IRMAA stands for Income-Related Monthly Adjustment Amount. It's Medicare's way of charging higher income retirees more for their coverage. The surcharge is based on your modified adjusted gross income, or MAGI. This includes IRA withdrawals, RMDs, and Roth conversions. It also counts capital gains from selling investments, interest, dividends, and even your rental income. For 2026, IRMAA begins when your MAGI crosses $109,000 for single filers. Even $1 over moves you into a higher bracket. For married couples, the first threshold is $218,000. Cross it, and your Part B and Part D premiums both rise. If you have between $500,000 and $5 million invested, you're in the perfect IRMAA trap. You likely have money in pre-tax IRAs and taxable brokerage accounts, and pulling levers in either one can trigger a spike. IRMAA usually isn't triggered by one single thing. It's triggered by stacking different income sources in the same tax year. One of the biggest risks is the survivor trap. When a spouse dies, the survivor often moves to single filing status with much lower thresholds for the same assets. To manage this, we focus on 3 specific levers. Lever 1 is withdrawal sequencing, choosing which account you spend from first. 2 retirees can spend the exact same amount of money, but have completely different MAGIs depending on how they sequence their withdrawals. We use Roth accounts as a pressure release valve. They help fund your life without adding a single dollar to your taxable income or your MAGI. Lever 2 is capital gains timing. In your brokerage account, you have the power to choose which specific lots you sell to control the gain. Remember, a gain can be tax efficient but Medicare inefficient if it pushes you over an IRMAA cliff. Always model it first. Lever 3 is Roth conversion sizing. The goal isn't just to convert as much as possible, it's to convert the right amount to fit your whole plan. Successful IRMAA planning happens in windows. Between 60 and 62, we set the runway by mapping your future RMDs and tax brackets. Between 63 and 65, the lookback window becomes real. Your income today will set your premiums in just 2 years. At 73, RMDs become a baseline. We use strategies like qualified charitable distributions to satisfy your RMD while keeping your MAGI lower. Healthcare coordination is actually cash flow planning. These surcharges are real monthly expenses that your paycheck plan must absorb. If you've recently retired or lost a spouse, you can appeal an IRMAA surcharge using Form SSA 44. It's a relief valve for legitimate life changes. IRMAA is a planning issue, not a punishment. Sometimes paying it is a fair trade for long-term tax savings, but you should never pay it by accident. My goal is to help you map your income so your retirement readiness is a clear decision based on numbers, not just a feeling. Visit investgrape.com to book your retirement income and tax map session. Let's keep your premiums predictable and your plan integrated. Stay patient and stay balanced.